Well, good afternoon, everyone. Welcome to this Pitcher Partners seminar on the windfall gains tax. Thank you very much for braving the atrocious weather that we have today and coming and joining us. My name is Craig Watman. I'm a partner in the tax advisory group here at Pitcher Partners, and together with Irina Tan, who will be joining us on the panel a bit later, I head up our transaction taxes area, which advises on GST as well as various state taxes nationally, including stamp duty, land tax, the growth areas infrastructure contribution, and now the new windfall gains tax here in Victoria. I would like to begin by acknowledging the traditional owners of the land on which we are meeting today, the Wurundjeri people of the Kulin Nation, and pay my respects to their elders past, present and emerging. So the way it's going to work today is that I will be giving an initial overview of the windfall gains tax, how it works, highlighting some of the issues that we've encountered since it was first announced. We will then be heading into a panel discussion for about half an hour thereafter, during which we'll address some of the more sort of in-depth, practical, commercial issues that hopefully you'd like to hear about, some of those issues that you are going to encounter, both leading up to this tax next year and once it actually comes into place. Following that, there will be time for questions from the audience, so please feel free to keep a mental note, or if you've got pen and paper, a written note of any questions that you do have as we're going along, and we will certainly be leaving time for those questions at the end, and the panel will be more than happy to answer them. So let's get into the presentation. So what is the windfall gains tax? Well, it's a tax of up to 50% when there is a value uplift of more than $100,000 due to a rezoning of land in Victoria, other than an excluded rezoning. When it was first announced on the 15th of May 2021, it was actually scheduled to commence on 1 July this year, so it would have already commenced based on the original start date, but was deferred following consultation between various bodies and the Treasury, who said that more time was needed to deal with some of the underlying issues that are associated with this tax. So the start date is now 1st of July next year. What land will be subject to the new tax? Well, it's basically any land in Victoria that is rezoned other than via an excluded rezoning, which I'll look at. And there's been a lot of focus, certainly in the media and the public sphere, on regional Victoria with this new tax and the impact that it might have on certain areas within regional Victoria, Geelong, Shepparton, Bendigo, etc. But there's been little attention paid to the fact that it is a tax that applies to the whole of Victoria. So it's not just rezoning events that can occur outside a GAKE area in a regional centre. It will also apply to rezoning events that occur within urban Victoria, and that's something that's been largely, I guess, ignored and is perhaps going to become a bit of a sleeper as we lead up to the commencement date of this tax. So if you fall within a category of an excluded rezoning, you won't be subject to the new tax, and they are outlined here at the bottom of this slide. So the first one is a rezoning between schedules within the same zone. So you do need to move from one zone to a different zone to be subject to this tax, not stay within the same zone. A rezoning to a GAKE contribution area, the GAKE being the growth areas infrastructure contribution. So any rezoning of land to the GAKE area will be excluded, as well as the first rezoning after 1 July next year of land that is already in the GAKE area. So if it's in the GAKE area and it is then rezoned, that will be an excluded rezoning. If there are any further rezonings of that land in the GAKE area, that will not be an excluded rezoning. So technically, you can still have GAKE land that would be subject to this tax if there is more than one rezoning that occurs in respect of that land from next year onwards. A rezoning to a public land zone or between different public land zones is also excluded, as well as any other rezoning declared by the Treasurer. And in respect of that last category, just hot off the press in the last couple of days, the Treasurer has actually already made a declaration of excluded rezonings under his discretion. And they are rezonings to any of the following zones, being Green Wedge A, rural conservation, farming, or rural activity. So note it's rezonings to those zones, not unfortunately, rezonings from those zones, which would be some of the major ones that would be caught by this tax. So I'm not aware, and perhaps Luana can answer the question later on about how often you would actually see a rezoning to one of these rural type of zones, but certainly they have now been declared, and the Treasurer actually announced that quite early on, that he intended to make a declaration that rezonings to rural zones would be excluded. Who is liable for the tax? Well, it's basically the owner of the land at the time of the rezoning event, or at the time that rezoning event takes effect. So where you have multiple owners, they will be jointly and severally liable for the windfall gains tax. Where you've got land that's owned in a trust, it will be the trustee of the trust as the legal owner of the land that would be subject to the tax. And there are actually broad grouping provisions in the legislation that are able to group multiple corporations and multiple trusts for the purposes of assessing this tax. It's basically designed as an anti-avoidance measure to ensure that the $100,000 de minimis threshold that applies is only used once by a group. So in circumstances where you've got a group of corporations or a group of trusts that own multiple parcels of land that are owned, that are rezoned by the same rezoning event, they would be subject to the grouping rules, and you'd only get the benefit of that $100,000 de minimis threshold at one time. But the grouping rules are very broad. So unlike land tax in Victoria, for example, where trusts cannot be grouped to form a land tax group, you can actually group trusts for windfall gains tax purposes, and even discretionary trusts can be grouped as well under the grouping rules. So very broad grouping rules. How is it calculated? So the starting point is the aggregated value uplift, which I'll discuss in more detail in a moment. Once you've got that, you take away any allowable deductions. So the legislation provides for a deductions regime by regulation. As we stand here and sit here today, no regulations have been issued by the Treasurer or by the government in respect of this tax and in respect of a deductions regime. And unfortunately, we're not even certain as to whether the government actually intends to implement a deductions regime for this tax. So the deductions regime was originally designed effectively to enable landowners to deduct costs leading up to a rezoning. So costs that they incur to give effect to a rezoning, and all of you who would have gone through a rezoning process would know that there are very substantial costs that need to be incurred if you are a proponent of a rezoning, particularly in one of the regional areas that I talked about. So the deductions regime was meant to allow for those costs to be deducted from the value uplift before you actually got your taxable amount that you applied the windfall gains tax rate to. But unfortunately, at present, we have no commitment as yet from the government to a deductions regime, so we're not certain whether that will be brought in over the coming months before 1 July next year, and that's still being pushed by the Property Council and others with Treasury. So once if you have allowable deductions, you take them off the aggregated value uplift, you get then your taxable value and you uplift, and you apply the relevant rate to that to get your liability. So how do we get the taxable value uplift? It's effectively, the starting point is it's based on the capital improved value, first of all. So different from land tax, where we're looking at site value, windfall gains tax is a capital improved value tax. So we start with the pre-rezoning CIV, or CIV1 as it's known, which is taken from the general rating valuation immediately before the rezoning event. So you have the rezoning event that occurs a certain year, beyond 1 July next year, in a certain month of the year. You look to the most recent general CIV rating valuation for CIV1. You then have what's called the post-rezoning CIV, which is CIV2, and that's determined by way of a supplementary valuation. So when the rezoning event occurs, the Commissioner of State Revenue will issue instructions to the Valuer General to go and perform a supplementary valuation of the relevant land And that supplementary valuation will be as at the same date as the pre-rezoning valuation. So the same date as CIV1, the valuer would go back and value the land at that date, but as if the land had been rezoned at that date. So the intention is to capture the uplift between the land in its previous zone to the land in its new zone, but both valuations would be at the same date. So that's how we get to the uplift. And just to give you an example of that, we've got a parcel of land here that was purchased in 2015, $250,000. It's in the Industrial 1 zone for a number of years. Then in 2025, it's rezoned to the neighbourhood residential zone. The CIV1, so the CIV at the date immediately prior to the rezoning event in 2025 is 400,000. The Valuer General conducts a supplementary valuation and determines that CIV2 is 600,000 based on the new neighbourhood residential zone. So that determines the uplift being the difference between the two of $200,000. And that would be the taxable value uplift that would be subject to the tax. So nothing to do with the sale price of the property. Here we've got a future sale of the property, for example, 5 years later, nothing to do with the sale price of the property. In fact, in previous years, all to do with the way it's valued from a rating perspective. The rates, we have quite a strange rate schedule, and the reason for that is because they wanted to exclude taxable value uplifts below $100,000. So if you generate a value uplift below $100,000 or up to $100,000, you will not be subject to the tax, so that's exempt. Then between $100,000 and $500,000, it's actually a rate of 62.5%, but that's only on the amount above $100,000. So if you do the maths, it basically works out at a flat 50% rate, which is the rate on everything above $500,000. So it's a 50% tax, so a very significant rate of tax, obviously, on the uplifts that are occurring. When is it payable? So you have the rezoning event, it triggers a liability. What will happen then is the Commissioner will issue you with an assessment. So you'll get a new type of assessment if you're a landowner that's subject to the windfall gains tax. It will be a WGT or windfall gains tax assessment will appear in your inbox or your mailbox, and you will have 30 days generally to pay that notice of assessment. The other opportunity that you will have within that 30 days, those 30 days, is actually to elect to defer part or all of the windfall gains tax liability. So instead of paying it within the 30 days, you can lodge what will be a notice with the State Revenue Office that says, I want to defer 100% or 90% or 75% or 50%. You can choose whatever amount you want, as long as you pay the rest within 30 days. I want to defer that amount under the election regime. Importantly, you need to get that election in within the 2 months. There is some discretion there, but if you don't follow the timeframes that are stipulated by the SRO, then you're going to face a liability which will be pursued without any opportunity to actually defer it any further and make installments. So from a cash flow perspective, obviously very important. A, that you're aware of your liability. B, that your assessments are coming to the right place so they don't get lost. Very important. We see that often for land tax purposes where clients ring us up and go, Craig, I've got this land tax assessment that the debt collection part of the SRO is now chasing me for. I wasn't even aware that I had an assessment. It's like, well, have you checked your details with the State Revenue Office recently? No, well, I actually moved from, that business address to this business address a few years back and I never notified them. So that's going to be the issue with those types of assessment. And unfortunately, the onus is on you as the taxpayer to update your records with the State Revenue Office. So if you don't do that, you don't get the assessment, you're going to miss out on the deferral opportunity. How does the deferral work? So as I said, you can elect to defer up to 100% of the liability if you're the landowner. That deferral continues until one of three things happens. The first is that a dutiable transaction occurs in relation to the land. So think sale of the land and a transfer of the land. So the dutiable transaction being the transfer of the land. If you sell that land, that will trigger a dutiable transaction, which will then cease the deferral of the windfall gains tax liability. So as soon as that transfer occurs, deferral ceases, liability crystallises, you'll have 30 days from that date to pay the full amount to the SRO. The second trigger is what's called a relevant acquisition. So that's terminology used in our landholder duty rules in Victoria. So think of a significant acquisition of shares in a company or of units in a private unit trust. They would both be relevant acquisitions for these purposes. And if that occurs, once again, that will cease the deferral of the windfall gains tax and crystallise the full liability. So if neither of those occur, you then have 30 years, basically, to defer the windfall gains tax liability. It becomes a first charge over the land, so very important. It's a first charge over the land, which obviously banks and other financiers will be very interested in moving forward, as well as potential purchases of your land. And interest does accrue at the 10-year Treasury Corporation of Victoria rate, which when this tax was first announced in May 21 was looking pretty good. It's looking a bit higher in recent times than it was then, but still a reasonably low rate. So the interest and the principal liability will accrue effectively over those 30 years. They're a charge over the land. There will be a windfall gain tax sort of property certificate regime that's put in place. So if you're familiar with the land tax certificate regime that the SRO has, where if you're a potential purchaser of property, you can request a land tax certificate to find out whether there's any outstanding land tax payable in respect of the relevant land. Similar regime will be implemented for the windfall gains tax, and that will show the deferred liability as well as any interest that has accrued. So what happens once the deferral eventually ceases? Well, then it's time to pay. So basically you've got 30 days from the date of the relevant cessation event to pay the liability in full to the SRO. But as I said, if things happen in the meantime, which are excluded dutiable transactions or excluded relevant acquisitions, then that won't cease the deferral period. So we'll come now to what is an excluded transaction. So these transactions, if they occur in respect of the land, won't cease the deferral. So the deferral can still continue in respect of that land. So in the dutiable transaction category, the first excluded transaction is an acquisition of an economic entitlement. So some of you will be familiar with our wonderful economic entitlement duty rules in Victoria, which have played havoc with development agreements since they were expanded in June of 2019. If you have an acquisition of an economic entitlement, so let's say a developer enters into a development agreement with the landowner, there's a profit share arrangement under that DA, that's an economic entitlement, the developer is going to incur a duty liability, but it won't cease the windfall gains tax deferral. So even though there's a duty liability under the economic entitlement rules, the windfall gains tax deferral will still continue in respect of that land. The next category is a transfer to a deceased personal representative. So under a will, it's also excluded. Any dutiable transactions which are for no consideration, so in specie distributions, gifts of property, etc., that are for no consideration are also excluded. However, in those situations, the transferee must formally elect to take on the accrued windfall gains tax liability and the interest in respect of that liability. And certain transfers of land between charities will also be excluded, but once again, the recipient charity must elect to take on the liability that's accrued. So they're all excluded. And then in the relevant acquisitions category, any acquisition solely due to a pro rata increase in the interests of all unit holders or shareholders. So you've got a company, you've got a company that owns a parcel of land, and you decide to issue some more shares to all of the shareholders in that company on a pro rata basis. That will be an excluded relevant acquisition that won't cease the deferral of the windfall gains tax, so the deferral can still continue. And interestingly, any acquisition of a further interest will also not cease the deferral. So think of that company again with shareholders. So let's say I'm a shareholder in the company, I've acquired a significant interest of 50%, paid duty on that. I then take another interest of 25% in that company. That's an acquisition of a further interest. I'm going to pay landholder duty on that based on a 25% interest. But because it's an acquisition of a further interest, it won't cease the windfall gains tax deferral. So you'll pay duty on it, but you won't pay windfall gains tax at that point in time. Rights of objection. So you will have the right to object, and there are going to be a fair number, I believe, of objections that will be lodged in respect of this tax. So there's basically two categories that you'll be able to object on with this tax. The first is in respect of the value of the land on which the windfall gains tax has been assessed. And the SROs recently released just some website guidance on this tax, and in that they confirm that you will be able to object to both the CIV1 value as well as the CIV2 value. So even though CIV1 is an event that would have occurred some time ago and you're outside the normal period of objection, because you get a new assessment for the windfall gains tax liability, you'll be able to object to either of the CIVs as part of that objection to the WGT assessment. You can also obviously object to the amount of the WGT liability if you think it's incorrect, or perhaps you think that it's not taxable at all because there's an exemption that should be applicable to you, and therefore you believe you have no liability. So those are the broad categories of objection. Importantly, though, those objections must be lodged within a strict 2 months of the issue date of the notice of assessment. Unlike land tax, for example, where the Commissioner has a discretion to accept late objections, there is no discretion in the windfall gains tax legislation for the Commissioner to accept late objections to windfall gains tax. So 2 months is it. If you miss out on the 2 months, then no more opportunity. So moving into the sort of exemptions framework, there is a category of what we call transitional exemptions that apply under the legislation. And they apply with respect to events that occurred before the magic date of 15 May 2021. And I remember 15 May 2021, it's etched in my memory. It was a Saturday. The Treasurer ruined my breakfast because I opened up the paper at breakfast and there was the announcement about the windfall gains tax. The Treasurer had decided to announce it on a Saturday morning, as he often does with new taxes. So 15 May 2021 is the magic date because it's the date that it was officially announced to the public. And if you can justify that you've done certain things from a rezoning perspective and met certain requirements prior to that date, then your rezoning may be exempt under the transitional provisions. So this first one for rezonings that were underway prior to that magic date require that the landowner had approached the council or the planning minister prior to that date to request the rezoning. The council had created prior to that date and registered an amendment request in the amendment tracking system, which deals with rezonings, or the planning minister had agreed to prepare the amendment, and the landowner had performed relevant work or paid for relevant costs, and both of those terms are defined in the legislation. There's a big long list of relevant work and relevant costs in relation to the rezoning with a total minimum value of 1% of the pre-rezoning CIV or $100,000, whichever is less. So if you can meet all of those requirements, so it's a cumulative list, you can meet all of those requirements in respect of a rezoning that was underway prior to the 15th of May 2021, then your rezoning may be exempt. The other category is in respect of contracts and options. So if you had a contract of sale that was in place, entered into prior to the magic date, once again, then that contract of sale will also, that land will also be exempt when the rezoning event happens. provided that the transfer of the land is not completed before the rezoning event. So you have to have contract of sale pre-15th of May, you then have to have rezoning event, then you have to have settlement of rezoning event afterwards. You have settlement of the rezoning settlement of the contract before the rezoning event, you lose the exemption. I have no idea why that is the rule, but that is the rule in the legislation. So the order has to be contract, rezoning event, settlement of contract. Sorry. Absolutely. So in order to get that exemption, you need to have the contract before the 15th of May 2021. You then need to have the rezoning event and settlement of the contract after the rezoning event. The settlement cannot occur before the rezoning event. And in a similar vein, options. So lands is subject to an option that was entered into prior to the 15th of May. Once again, the terms of the contract must have been settled. So you'd need to have a contract attached to the option with settled terms. And the option either must not be exercised, or if it is exercised, the sale must not complete. So settlement must not occur before the rezoning event. So once again, you can't settle the contract. You can't exercise the option and settle the contract before the rezoning event if you want to qualify for that exemption. And in terms of other more general exemptions and waivers, we've got the residential land exemption, which applies for an exemption of up to 2 hectares of residential or primary production land, provided that the relevant land includes a residence that's fit for occupancy. So if, that gives you an exemption, but only for the first 2 hectares of the land. The remaining part of the land would then be subject to the tax. Any rezoning that occurs to correct a rezoning error will also be exempt, and any rezoning in respect of charitable land will also be exempt. And university land held by universities was also added a bit later on as a result of some lobbying by the university sector. But that land must be occupied exclusively for charitable purposes for 15 years. So just moving to some issues of concern that we've come across in the time that we've been looking at this tax since it was announced. The first one is really the limited deferral opportunity, if you like. So 30 years sounds like a good period, but where you've got a sale transaction in the middle, which will then cease the deferral and crystallise the liability in full, it may well give rise to circumstances where the cash flow may not completely match up with the liability. And importantly, if you don't elect to deferral, there's going to be a number there's going to be a number of situations where the cash is simply not going to be available to meet the liability. So it is a difficult regime from a cash flow perspective, and the deferral regime will play a critical part of ensuring that landowners can actually deal with the cash flow implications of this, particularly where they're entering into arrangements with developers and purchasers and other parties in respect of the land. There's also confusion regarding the GAIC versus non-GAIC land. So as I said at the very beginning, GAIC land is theoretically subject to the tax, but only on the second and beyond rezonings after 1 July next year. So as long as you only have one rezoning of GAIC land, it shouldn't be subject to the windfall gains tax. But in circumstances where you've got non-GAIC land that becomes subject to an approved PSP or precinct structure plan, there's been a bit of an issue around as to what the effect of the PSP being applied to the land is from a windfall gains tax perspective. It's not clear really in the legislation, and it's not dealt with in the SRO's website guidance as to whether that addition of the PSP is actually a rezoning event, whether it's excluded because it's a rezoning between the same zones, or whether it's really just an application of a schedule to the zone which doesn't fall within a rezoning event at all. I think the last option is probably the better view, and certainly the one that we think applies in this situation, but we definitely need to get some certainty on that moving forward to ensure that the application of a PSP to land won't give rise to a windfall gains tax liability. There's uncertainty regarding the effect of nominations under contracts of sale and option agreements, where those contracts of sale or option have transitional exemption applying to them. So it's unclear at the moment whether if you were to nominate a new purchaser or grantee of an option, whether you would then lose your exempt status if you were entitled to the exemption for transitional purposes. And then there's really just a lack of practical information. So the SRO's recent website guidance goes some way to addressing this, but there's a whole range of valuation issues, which Luana will talk to shortly, issues about how the assessment process is going to work, how the deferral process is going to work, how it's going to link to PEXA from a conveyancing perspective for sale transactions, the payment process, and really just how the SRO is going to deal with it. You know, the SRO is really struggling at the current time to actually turn around matters. For any of you that are dealing with us or are dealing with your own matters with the SRO, you would know that the times have really blown out for objections, ruling applications, and more general matters as well. And this is just going to add another layer of complexity to the SRO. So it'll be really interesting to see how this is dealt with from a practical perspective. And then some watch outs just for landowners, developers, purchasers, joint venture partners, etc. So obviously the impact of this tax on contractual arrangements, contracts, options, development agreements, joint venture agreements, all range of contractual arrangements in relation to land that might be rezoned in the future is a critical aspect of this. And it's one that is already being dealt with by those that are aware of it and those that are getting good advice in the lead up to this tax in respect of transactions that are being entered into now, so prior to the commencement date, but that are in respect of land that will potentially have a windfall gains tax liability attached to it from 1 July next year. So it's very critical as a party to one of these agreements to understand what the potential liability is, and perhaps even more importantly, who is going to be responsible for the liability and how it's going to be dealt with. So you need a decent lawyer who understands the windfall gains tax to put in appropriate provisions into these arrangements. In our view, there is going to be a potential for a two-tier market to be created as a result of this between GATE land and non-GATE land. If you work out the figures, the GATE is much cheaper than the windfall gains tax in respect of some of these parcels. Unfortunately, that means that the regional areas, which are meant to be the more housing affordable areas, for example, outside of the GATE areas, may well suffer from a housing affordability perspective. I don't think it's an issue that the government's thought through properly, to be honest. I don't think it's not. It's certainly one that we've been vocal on when we've had the opportunity from a housing affordability perspective. You know, the government is big on housing affordability, but I don't think this tax stacks up in terms of that issue. Metropolitan Melbourne rezonings initiated by state and local government. So I think, as I said at the very beginning, I think that's a real sleeper with this. You know, obviously, if you're a landowner in a regional area and you're a proponent of a rezoning and you're getting good advice, you're aware of the windfall gains tax and you can deal with it appropriately if you get some decent legal advice and plan for it. But if you're an owner of a garage in metropolitan Melbourne that's part of a precinct that the local authority suddenly decides they're going to rezone into something else because they want to turn it from purely commercial or industrial or whatever it is into a mixed use, perhaps with some residential elements for some infill housing, then you've got no control, absolutely no control over that process whatsoever. You're not pushing for it. You perhaps you don't even want it. You probably, you know, you're quite happy to keep running your garage that's been running your family for the last 50 years. But if your property is part of the zone that's going to be rezoned, and the Valuer General determines that there's a windfall in respect of that property, you will be subject to this tax unless the Treasurer declares all of those zones to be excluded zones. And that's really the only out in the legislation, is if the Treasurer decides to do that. And then there's the always the potential implications for other states and territories. Unfortunately, Victoria's had a bit of a habit of bringing in new taxes that other states and territories have copied. Think the FPAD and the AOS, the foreign surcharges for stamp duty and land tax purposes. Victoria was the first state to introduce those. Now we have them in almost every other jurisdiction of Australia. So we'll just have to wait and see. No doubt the other states and territories will be looking at this quite closely to see how it plays out in Victoria. With that, we are going to move into our panel discussion. So while I invite the panel to come up and have a seat, please, I will briefly introduce them. So firstly, we have Luana Kenny. Luana is the Managing Director of M3 Property in Victoria. And in addition to her role as Managing Director, she's also responsible for the residential development team nationally. She provides valuation and consultancy advice in respect of residential developments, including high-rise apartment developments, townhouse projects, land subdivisions, including master planned estates. Welcome, Luana. And over the far side, we have Brad Paddon. Brad is a co-founder and director of APD Projects and has an extensive background in the residential property development sector across Victoria, Queensland and WA. Prior to co-founding APD, Brad worked in executive level roles with listed developers Stockland and Satterley Property Group, and he has led the delivery of significant master plan developments, including the award-winning Highlands, 7,000 lot master plan community Craigieburn, the award-winning Salandra Rise in Clyde North, and the Coburg Hill infill development in Coburg North. Welcome, Brad. And in the middle, we have Irena Tan. Irena is a partner with myself in the tax advisory group at Pitcher Partners and co-leads the transaction taxes team with me. Irena is a state taxes specialist, particularly in stamp duty and land tax. Prior to Pitcher Partners a number of years ago, she was with the SRO and then saw the light and came over from the dark side to the light side. Welcome, Irena. All right, so we're going to kick off with some questions. As I said, there will be some time. We're doing well in terms of time, so please think up your own questions. There will be time at the end. So we might kick off for a question perhaps to you, Brad, first, which is really, I know that you've been involved in transactions over the past year or so that have had potential windfall gains tax implications in the future. In your view, sort of taking that experience into account, what have you already seen by way of impact on the market, and what do you think the impact's going to be moving forwards?
Thanks, Craig. It's a mess. I think it's very magnanimous of the SRO to defer the implementation for 12 months, but I think they really needed that because so much of what we need to know from a development practitioner's point of view is being fleshed out in these progressive and periodic releases of information on the SRO website. But I think the short story is that there's a lot of confusion. I kind of asked Luana what my windfall gains tax liability is going to be on this site. I don't really get an answer because it's really hard to know. We've been pretty heavily involved in regional Victoria for a number of years now, and I think there's a myth out there that there's, enormous profits being made out of the development industry at the moment. The reality is a lot of margins are tightening up anyway. At the moment, we're in a situation where we're seeing price stabilisation, probably price correction, coupled with a superheated construction industry. So we've taken the view that we're deferring transactions at the moment. A couple that you're very ably advising us on are underway, and they're in this sort of transitional zone. But I think the short story is a lot of people are scratching their head trying to work out what this means. And in our instance, where we've just sort of put the queue in the rack on a couple of acquisitions that would have otherwise made sense.
Just on that, do you think it leads developers like yourself to looking at opportunities elsewhere outside of Victoria because of taxes like this?
Oh, look, I echo your sentiment. I think there's an unyielding assault on the property industry and perhaps the development industry in particular to help generate a tax base We operate in a couple of other states, and the tax and contracting regimes are a lot easier to get your head around. Economic entitlement that you measured as well, you mentioned as well, I think that's a huge issue. And I think probably one of the things that WGT is going to do is push a lot more people into the development agreement space now when we're talking with landowners. I think that's an inevitable consequence. And yeah, we're heavily involved in Southeast Queensland, and very happily so.
Luana, would you like to add your comments?
Sure. We've been involved in advising a few owners on what their tax liability might be, because they were in the middle of negotiating contracts, particularly in regional areas. And so each party's just had to navigate their way. We were involved with the property that was going from an industrial to a residential zone, and a number of parties pulled out of the transaction just because it was around the time that this was announced. And no one was aware of what that ultimately did. So the transactions are still going ahead, but they're taking longer, and they're trying to navigate their way. Well, how do we include this into our contracts and safeguard both the vendor and the purchaser?
Thank you. Next question is sort of about what we can do to minimise the impact of this tax moving forward. So we might take each panellist in turn. Irina, we'll start with you. What strategies do you think can be used leading up to 1 July next year, as well as after the commencement of the tax, to try and mitigate the impact of it moving forward?
Yeah, that's a great question that I think we're getting a lot of at the moment. So from a technical perspective, I think the first no-brainer strategy is to consider whether you can maximize access to any available exemptions, in particular the transitional exemptions, given that there's still so many uncompleted contracts of sale that were entered into before the 15th of May that are still on foot. So firstly, work out if you can actually rely on that exemption. And then if not, then it becomes a matter of trying to maximize as much as possible the once only deferral opportunity, so that at least from a cash flow perspective, you're going to be relying on that quite heavily. You don't want to miss out on it just because you've accidentally, entered into a transaction such as a sale of land, where you otherwise have other structuring alternatives, such as entering into a development agreement that then brings to an end that deferral arrangement prematurely. So I think that's the key one. And I think underlying all of that is really to consider sort of the structuring of acquisitions and other transactions properly. So the usual ways to obviously consider tax, income tax, GE, land tax, GST, as well as commercial and legal considerations. But WGTs now needs to be added to the list, definitely. And I think it's just with proper planning, hopefully you can sort of mitigate the pain a little bit, especially if they're going to be facing a liability. So I think that's one of the key ones. The other one is about managing CIV1, and perhaps Luana, you might want to talk about that a little bit more later. But given that CIV1, it's a difference between CIV1 and CIV2 that gives you the uplift on which tax is going to be paid. Perhaps managing CIV1 as much as possible to keep it as realistically high as possible if you can. That might sort of preserve, I guess, or limit the damage a little bit. But yeah, Luana can speak about that hopefully a little bit more from a Val's perspective. And I think more practical tips and strategies is about, while like deductions, for example, even when we don't quite know yet whether regulations are actually going to be released on deductions at all, and if they do, what will they include? I think it makes sense to keep good records of all costs sort of incurred in relation to pursuing a rezoning. Such that if we, come a time that regulations are actually issued and we actually know what deductions are actually permissible, you at least have got the records ready to go. I think the other one is to keep an eye on deadlines as well. So as Craig mentioned before, they're very tight timelines as to when you can object, when you can elect to defer the WGT. So you definitely need to keep a very, very close eye on those deadlines, because I can tell you that you'll be in a world of pain if you happen to miss out on electing to defer the WGT on time, as well as object to the imposition of WGT on time as well. I think the only final comments I have, Craig, is really to highlight that this is a really new tax. I mean, technically it hasn't even commenced yet. So practice management, risk management, optimization strategies are still being developed and optimized over time. And it's very unlikely that we'll have like a magic sort of solution that will fix everything for everyone. So it really requires a lot of careful planning and a very sound understanding of the windfall gains tax rules. And landowners, developers, investors, financiers as well, we need to ensure that they're well advised because it's too easy to get it wrong.
Absolutely. So you're basically saying everybody should come back to Pitcher Partners in 12 months' time for the next seminar.
I am. Thanks, Greg.
Thank you. Luana, would you do it? Yeah, I'm just on that point about CIB1. You and I were having a chat about that before we started, and there's been a lot of noise in the marketplace about that. What's your view on trying to manage CIB1?
Yeah, sure. It is a hot topic, and look, the Act's really vague, and that's creating a lot of issues at the moment. And so the number one question is, well, what does CIB1 actually have regard to? And purely from a valuation point of view, the difference that I see, and it's my opinion that there's no guidance out there on how it's going to all work, is between uncertainty and a timing with the values. So if you're assessing a value in 1 January of a year, let's take this year, let's say that your rezoning occurred today, the Act says your CIB1 is immediately before the windfall gains tax event. From a valuation perspective, yesterday I knew that rezoning was occurring. So from taking that into consideration, the market is fully informed. CIB1 has regard to the Spencer definition, and that is the perfect market. That is, parties are informed, parties know what's going on. We all have been through rezonings, or some of us might have been. 2 years turns into 4 years, 4 years turns into 8 years. So you don't want to be objecting to your CIB now to be getting it up. You have the opportunity, as Craig said earlier, you can object to both the CIB1 and the CIB2 at the time that you're issued your certificate. Worry about your CIB1 and 2 then, because you don't know what's happening. So if you start looking at it now, that you don't have any sort of direction, you don't know how it's going to play out. So there's no point trying to deal with that. You deal with the facts at the time that the CIB is to be assessed. And so in the year that you're rezoned, you're fully informed, you know that a rezoning is coming. And so it's just really a difference between uncertainty and timing and the cost of getting that rezoning. So I do say there will be a gap, but I don't know if it's going to be as big as what people are anticipating. And you need a really good valuer to.
Oh, of course, goes without saying. Brad, just to round that off, based on your experience, if someone was entering into a transaction today that has potential WGT liabilities in the future, what advice would you be giving to them? Other than coming see Pitcher Partners?
Yeah, I was going to say ring you, Craig. That's my default. Look, I think I agree with Luana. Looking at your rates valuation, everybody knows that that's a fairly conservative opinion. And look, we're working on a couple together in regional Victoria at the moment. I won't talk specifically about this site, but we've bought through a protracted negotiation a piece of land that is in regional Victoria. It's in a rural zone that has been well flagged to be transitioned to an urban development site. And we've paid something approaching rezoned values because our view was that the rezoning was so sufficiently progressed that for all intents and purposes, that rezoning will occur. And we paid a lot more than the rates valuation would have said. And so there's this perverse kind of argument out there, which Luana's touched on, is that should we as landowners be objecting to our rates notices now and our annual valuation to get that up so we pay higher rates in the short term, which none of us really want to do, but accept that imposition over a higher windfall gains tax liability later on. So I think other than tax accounting, valuation is going to be the best business in town for the next couple of years. There'll be objections everywhere. And You talked about the SRO's ability to resource itself, and we agree. There's a lot of, you know, deferred appeal issues, but the VG is really the other one in this, because I think the minister gets CIV1 and CIV2 from the Valuer General, and their ability to deal with all of the valuation work that is going to absolutely flow from this is going to be another big key issue.
Can I just add to that? So I think we do focus on CIV, which impacts your council rates, but when the highest and best use, and it's known in the market that it is ultimately for redevelopment, subject to the rezoning, you've got to be careful that the following year you don't end up with a site value exactly the same as your CIV, because then you're getting hit harder with your land tax, and the land tax is the killer. So I think it goes back, just make sure you get the right advice. We provided some advice recently for a property where the council rate notice said $3 million on the CIV, and we put $50 million on it, and their rezoning's probably a couple of years away. So the last thing you want is to suddenly end up with a site value of $50 million, because you're not sure when your rezoning will come in, or when your windfall gains tax liability might flow, because you've got to weigh it up.
Keep paying that for a very long time,
Yep.
potentially. Yeah. Right.
I think the other one, to use the example from the SRO website, where a farmer is the owner. When a rezoning happens, the farmer gets the WGT notice. They elect to defer for, let's say, 100% for 30 years. It then gets sold to a developer. That's a what is the right word? We've got to pay the WGT at that point.
Yep.
There's no ability for the developer to then defer that, like the GAKE mechanism, which is a well understood, a workable, effectively tax regime. And so we've then got the other issue about, well, how do we fund that? Is a bank going to fund that? And I think, correct me if I'm wrong, we also end up paying stamp duty on that WGT as well, just for the privilege. So there's a bunch of stuff here that, you know, and I've mentioned this in a couple of industry forums, that deferral mechanism is key to ensuring that we get orderly payment of WGT when cash flow can allow that to happen. Because as you rightly say, we've got a housing affordability crisis in this state, as we do in lots of places in Australia. This isn't helping. You know, and it wasn't that long ago that there was another tax imposed to try and help subsidise affordable housing levy as well. So, you know, that deferral mechanism, I can't stress enough, that's one of the biggest issues that I sincerely hope the SRO changes their tune on that.
Thank you. All right, so we might move on to some specific valuation issues, Luana, because they are very important. So from a valuation perspective, what are the particular issues that landowners and developers need to be considering leading up to 1 July next year, and then beyond, to try and deal with this moving forward? We've already touched on some of this.
We have, and I think, crossing over with the last question, we're telling clients, keep a record of everything. So if you're getting offers, keep a record, because it's all going to go to dealing with the case when you ultimately have to look at your CIV1. And think in terms of what you can do, it's probably just being alive to the issues and making sure that you're getting the right advice. There's no particular valuation things that you can be doing. You just have to let the process run itself. But going back to Craig's point on the objection period, you do only have 60 days. And the 60 days is from the date of that notice. So if it takes a week to arrive, don't let it sit on your desk for a month, because there are things that need to occur. And so you have to be alive to the issue. So if you know that one's coming, then it's really important that you get that time in, because we have had land tax notices come to us a month after they've been due to be objected to, and there's nothing we can do. So I think that's really the key, but your record keeping is going to be key. Even if you don't know if it's material, it's better to have everything there, including the rezoning period, what was being done along the way, what the market knew, because that all goes to that CIV1, that under the Act, the valuation is to reflect the highest and best use, including the existing zone and any potential. So by default, CIV1 should be reflecting that potential that you've been working on for the past few years.
I'm sure you're getting this question and maybe there's no answer, but if someone's coming to you and saying, look, Luana, this land's going to be rezoned sometime in the future, 5 years, 10 years, is there any way you can tell me what the range of the WGT liability is going to be? What are you saying to them?
So it is difficult. We don't have a crystal ball. We can't do it, but we can certainly provide advice, and we have been providing advice based on the known facts at the date. So we will assess a CIV1 and a CIV2 as we understand it, but we'll make assumptions that the CIV2, that the rezoning occurs in the year that we are providing the advice, and so that you get the gap, assuming it was all occurring today. We disregard the council rate notice, so we don't assess it on that, because CIV is not always right, as Brad says. It can be conservative, but it can also be high.
Yep.
So we're just doing it that way, providing a range. We are currently taking a bit more of a conservative approach in terms of what that CIV1 is, purely just so that we're not understating what any liability will be, because until those guidelines come out and really give us an indication as to how the Valuer General is going to deal with CIV1, it can be a bit challenging. But we can certainly provide advice. We have been providing advice. I feel like I get a question every week, Luana, what do I do here?
Yep.
And the three things that I say is, don't object to your CIV, just wait, hold off, document everything, and we can provide a liability estimate, and then away you go. At least you've got a little bit of direction.
Thank you. All right, so let's move to a bit of an example, and we'll put this to you first, Irina. So let's take a unit trust that owns commercial property in Dandenong, which is rezoned to mixed-use commercial and residential in late 2023. So the sole unit holder in this unit trust needs additional capital to redevelop the property based on the new zoning, and is looking for an investor to inject capital for the redevelopment project. So land in a unit trust, and we want capital to come in for a redevelopment based on a new zoning. So what structuring options? Let's say, sorry, I should have said that the rezoning subject to the windfall gains tax. The unit trust has elected to defer that liability. So what structuring options are then available to that unit trust unit holder to inject the capital?
Thanks, Gary. I think the key thing there is to note what you mentioned there, that in that example, we are assuming that there's a deferral arrangement already in place. So I guess the key thing here is, as you're considering all the options available, is to work out what sort of overall best, but also, I guess, hopefully something that's not going to prematurely cease the deferral arrangement in place. So if we think about the sort of more obvious sort of structuring options that come to mind, it might be that the investor, whoever that might be, might come onto the title. I mean, that's kind of a standard transfer of land scenario, in which case the unit trust and then the investor end up becoming co-owners of the property. The problem with that, from a WGT perspective, is that transfer of land, even if it's for, say, a 20% interest, immediately makes 100% of the WGT payable. So, whilst it's a simple, I guess, structuring idea, from a WGT perspective, it's not too great. I guess an alternative to that would be to consider perhaps an indirect acquisition of the property. So perhaps the investor could take up units in a unit trust, but again, that's sort of subject to whether or not that acquisition is going to be a relevant acquisition. If the unit trust is a private unit trust scheme, that threshold for significant interest is 20%. So if they're only investing 19%, perhaps that's okay. If it's a unit trust that's sort of wholesale, you've got 50%, and if it's widely held, that's 90%. So again, need to be careful there, even with an indirect acquisition of an interest in the property. I think the other one is what you mentioned, Brad, earlier, which is really to consider the use of development agreements. So whilst I think a lot of people have been scared of them a little bit because of the 2019 economic entitlement rules, I think now with the WGT coming into place, I think like DAs will be in vogue again, because what's the less of the two evils here? Some economic entitlement duty is probably likely to still be a fraction of bringing forward 100% of the WGT liability when it just doesn't align to the development cash flow proceeds. So yes, you might need to sacrifice a little bit and pay duty on a development agreement under which the investor takes a cut of the profits. but that might be preferable to the other two structuring options I mentioned earlier. And I think the other one really is to consider whether the investor can provide loan funding, and, you know, provided it's doesn't involve a dutiable transaction or any relevant acquisition at all, then that shouldn't touch the deferral arrangement in place. And I guess the last is a catch-all to see whether you can do a combination of those structuring options. So perhaps a loan plus a DA to sort of, I guess, manage the economic entitlement duty exposure, plus, I guess, seeing whether you can provide some of it by way of a loan as well. So I think those are the key ones that come to mind. And I think they're the key ones that we've kind of been sort of working through with our clients to date. And no doubt, I think these things will be refined over time. So there could be other options out there that I haven't thought about already, but yeah, those are the key ones for now in that example, I think.
Thank you. So yeah, really interesting sort of thought process that investors would have to go through and landowners would need to go through. As Brad said, this deferral regime is going to become so critical moving forward. So doing something that potentially doesn't crystallise the deferred liability will become perhaps more of an attractive option than it otherwise would have been before this tax came into effect. Brad, do you have any other sort of thoughts on that example?
Well, on the structuring, no, I'd ring you for that. But I tend to agree. Lorena's point is that I think, that was probably the other part, existing development agreements. So before the magic date, they're not carved out of this. And a lot of those can be set on percentages of revenue or based on some land value mechanism. And, we're involved with, or we're not involved, but we're loosely advising somebody who's got one of those at the moment. And our view is it's, until we can get clarity around what the WGT liability will be, and it's a difficult one, we don't think it's viable. And that's a real shame, because a development agreement really is a contract. In a roundabout kind of way, it's a contract. And whether you choose to sell via a development agreement or you sell via a contract of sale, you've made an economic assumption around what's going to happen. But I do think that the development agreement pathway is going to make a lot more sense, and keeping your WGT, or could make a lot more sense, and keeping your WGT deferral intact. And so that stamp duty on the economic entitlement is going to be a fraction of the headache that could come from the WGT liability.
Yeah, you almost need a bit of a spreadsheet to work out what's the best of the worst. But certainly the other point probably to mention is that there has been a lot of work, excuse me, my voice is failing me. There's been a lot of work done on DAs since the EE rules came into effect. So a DA before June 19 is a lot different these days, taking into account the EE rules. So there's a lot of different options that you can consider from a DA perspective if you're trying to stay out of the economic entitlement regime. And as Brad just said, it may even be worth having to bear the pain of an EE duty liability in order to not crystallise your WGT liability. So just finally, a bit of a crystal balling or power question, if you like. If you were in power, and we'll start with you, Luana, if you were in power, if you're in government, you'd make it very good Premier, by the way, and assuming you didn't have the option of simply repealing the windfall gains tax, what sorts of changes would you make to the tax to make it more equitable and workable from your point of view?
We have touched a little bit on it today, and it's the regional areas where they're going to get hit the hardest because they don't have the GAIC. And so I think to make it more equitable and fair across the land subdivision space in particular, that we'd have to look to at least cap it. So I have done recently some advice to try and estimate a liability, and I analysed that on a rate per hectare, and it worked out to be about 200 to 250,000 in tax per hectare, which is double what a GAIC is. So to make it equitable, then it should just be capped at what Metropolitan Melbourne is copping in the growth areas within the regional areas as well, to cap that.
Yep.
Because it is quite a significant impost.
Yeah, no, really interesting. So GAIC, you're familiar with it, about $100,000 per hectare. So double that in Luana's example for WGT. Brad, I know you'd get rid of it if you could, but if you can't do that, what else would you do?
Yeah, I think, Treasurer's got a difficult job. I think the state's up to its eyeballs in debt. Governments like getting rid of revenue sources, but I would repeal the windfall gains tax and I'd throw it all in the bin, and I would apply the gate regime, which is well understood. It works. Deferral mechanisms align with developer cash flows, and I would, to take Luana's point, equalise it, because these are the same regional areas that have had, by virtue of the COVID transition, unprecedented growth. Land supply is in short supply in a lot of regional towns. They've seen big price increases, and our back of the envelope numbers are similar to yours, Luana. Depending on where this lands, we'll be paying more than double the gate in a lot of regional areas that we operate in at the moment. And government's trying to get people to go there. We're trying to host com games. We're trying to get accommodation for athletes, and it's just all of this stuff it's backward in my view. So.
And Irina, anything further that you would do?
Oh, where do I even start, Craig? I think to address that quantification conundrum, I agree with both of you that the rates should be equal to the gate rates effectively. But I think in terms of how you even quantify the liability in the first place, I like that scrap, or change completely. We want something that is, I guess, more tangible or actually more workable. So whether it's rates per hectare or something that gives a lot more people a lot more certainty, I think it's where I'll start first to address that quantification conundrum. And then the second one would be to expand the scope of the exemptions. I think good that they have a few exemptions here and there, but they're quite narrow in scope, and it's so easy to get things wrong as well. Like you pointed out, we don't really know why it is that it has to be contract rezone settle. Why not just contracts pre-15 May 2021, full stop? I mean, that will be so much. And development agreements as well. And I think on that point of 15th of May, the day that your breakfast got ruined, I don't think that's the appropriate cutoff date anyway. So on that date, all we knew was the name of the tax called windfall gains tax. Yeah, but aside from that, we didn't know who exactly was going to be liable for it, how it was going to be sort of quantified, what's the scope of exemptions, transitionals, et cetera, et cetera. So we really had nothing. And in fact, it was exactly a year ago from today, the 13th of October, 2021, that was the date we finally got details. That was the date that the bill was read for a second time. And I would argue that a more appropriate cutoff date would have been the 13th of October, 2021, rather than the 15th of May, 2021. And I think in terms of the deferral too, I would obviously keep it in there because I think it's great to have the deferral opportunity, but I'll change it such that it's not just once only, so that developers buying land from vendors where the land has already been rezoned can actually access the deferral opportunity and sort of maximize the staging benefits, because right now that staging benefit really only sort of is available to developers who were the landowners at the time the land was rezoned. Yeah. Otherwise, they just don't get that benefit. So I'd like to align the incidence of when the tax becomes due to be paid to the SRO with the realization of proceeds based on the sale of the development stages over time.
Which the GAIC does quite well.
Exactly. So yeah, so make it more like GAIC. I don't even know why they didn't just extend GAIC, but I think the government doesn't like GAIC, and I think that's the key reason for that. I think the deductions too, I mean, again, there's still a question mark as to whether we will actually get regulations on the deductions at all. I think that was what the government said initially, and then they kind of sort of back away or shied away from that a little bit, and now it's still uncertain. I would actually want to enshrine that in the actual legislation and maybe make it sort of broad such that it relates to all costs associated with rezoning. I think that's only fair, especially if the idea is to capture a windfall from rezoning. I mean, how can you capture a windfall if it's all just on paper and just completely ignore costs associated with the rezoning? That just doesn't make sense to me. It's a windfall for the government, but not windfall for anyone else. I think that's probably all about it, but I think there's one last thing actually. I think you, Craig, mentioned about the urban infill sites getting rezoned due to not sort of proponent-led rezoning initiatives, but third parties or local government. I think that in terms of fairness of a tax, that's actually quite different from other transaction taxes such as stamp duty, where a transferee who takes the transfer of land actually has the choice to take the transfer of the land, and obviously that bears the cost, the stamp duty cost associated with that transfer of the land. The WGT is completely unfair because in such situations, you could have people who have not pursued any rezoning of the land suddenly get hit with the WGT assessment. And this is all based on actions taken probably by local councils. And obviously then the SRO gets wind of the rezoning initiative and then instructs the Valuer General to, conduct a valuation of the land. I would like some integrity or some checks and balances, I think, inbuilt somewhere in the legislation or outside of it to ensure that in such situations there are sort of like protections. So for example, maybe if we can't expand the scope of excluded rezonings, then perhaps giving such landowners, I think, I guess a more expanded scope of objection rights perhaps, or perhaps even introducing, I guess, an independent body for them to air their grievances if possible, because I think that's a really, really unfair situation.
Great. Fantastic. Thank you all. That was a really good in-depth discussion on some of those issues, so appreciate your thoughts. We are going to move now into a time of audience questions. So I believe there are some roving mics that can come around. If you wouldn't mind just raising your hand if you do have a question, and we'd be more than happy to answer it. Any questions? Or have we answered them all?
Craig, you and I obviously know each other. Ben Griffiths from Henley Properties. I've just got a basic one, which I think you may have covered off, but I'll try it on you. We own some rural land, and it's going through a rezoning, but we own it, so we're subject to the windfall gains tax. Does the subdivision and of stage 1 and the registration of that plan and the settlement of those lots, does that trigger the payment? If we so let's say we elect to defer it, but does the settlement of those lots, does that trigger the payment?
Irene, I've got no voice left, so would you mind answering that question?
Sure, no worries, Craig. Sorry about your voice. Yes, so deferral in place and then a settlement involving a transfer of land. Yes, unfortunately, that will be an event that will cease the deferral arrangement because it will be a dutable transaction, being a sale or transfer of land, unfortunately.
But you might just want to mention the child lots sort of scenario where it's subdivided.
Yeah, sorry. So in the context of a subdivision, so a project involving subdivision, you do get the deferral sort of a portion to the child lot. So the deferred WGT liability, a portion to the child lots created by the subdivision. So it's only when you sell off those child lots that the deferral will come off those lots only, but the ones that you haven't sold yet, that should retain its deferral arrangement in place until such a time that those child lots are then also sold together with the rest.
Thanks, Ben. Any other questions? Bonnie, mic coming. Oh, sorry. Question here. Sorry, first. And then Bonnie. Thank you.
Hi, Matt from Integra Group. We're also regional developers, but and Brad, like you, the gate would obviously work a lot better if we had to have something, and at least then the tax might get spent in the area that they're actually taking it from, which would be handy as well. My question might a simple one as well, but if we're looking at economic entitlement, so we go with a DA agreement, which I agree is going to become more in vogue. We try to go for an economic entitlement. We're therefore looking to Luana to try to give us as low a valuation as we possibly can. And in that same year, we actually have a rezoning event, which is the trigger event. Are we providing the valuation of the first assessment at the time of economic entitlement, which is as low as possible, and then we're receiving as high a one as we can when we're arguing for the COV? Are we actually arguing conflicting within a few months of each other, possibly?
No, because the valuation reflects different purposes. So you have no obligation to provide that first valuation because that valuation was prepared for a particular purpose. And it does happen with investment valuations, book values, etc. They're different. The CIV is very clear under the Valuation of Land Act what you can take into consideration, and it falls under the Spencer definition. And so we would be assessing a CIV that has regard to the Valuation of Land Act rather than the market value for your purpose of a development agreement. I mean, at the end of the day, when you're talking about land, values are values, and you're adopting the same sales, and so technically there is only one valuation. But things also do evolve and happen through that year. You know, who would have saw a pandemic coming, and you know, all things were pretty good at the start of 2020, and then a pandemic hit. But so no, you don't have to answer that. Two different valuations, two different purposes.
Thank you. Bonnie.
Hi everyone, my name is Bonnie. I work for the Dennis family. So my understanding of actually it's a two-part question. So assuming the UGB is extended at some point, do we envisage, or is there an expectation that the gakeable area will exist immediately adjacent to a windfall taxable area? And then part two is, if windfall gains tax is an alternative to GAKE and goes into consolidated revenue, do we have any intel on how the windfall gains tax is going to be deployed on public infrastructure, etc., as part of the legislation?
Yeah, do you want to answer that second part, and then the planning question, anybody can answer?
I'll take that second part. I think that the difference between the two is obviously GIG revenue is hypothecated, whereas WGT just goes into the general pool that they can use for whatever purposes. So I'm not entirely sure if we're going to see full transparency as to how those funds are going to be utilised. I think, again, going back to Craig's last question, which was a great one, if we were in a position of power, it could change on the legislation. I guess, aside from scrapping it, I would love to, I guess, get some transparency and reporting in terms of how the WGT funds get used ultimately. And I guess in addition to that, I would like to see reporting on how much they actually collect from the rules, from the WGT once it goes live as well. But yeah, I'm not aware of any commitments to sort of disclosing all those things at this stage.
Budget repair, I think, is the answer at the moment, Bonnie. And on your sort of the expansion of the GAKE area and zone, do you have any indication of what might happen in the future, Diana?
No, I don't have any indication. We were actually talking about that as a group last week, and how that might play out. And we workshopped it. We probably thought that that land just outside the UGB, if that's expanded, it would then ultimately be brought into the GAKE contribution area and get an exemption that way.
Thank you. Yes.
Bryn Aldrich, a solicitor. Craig and Irina, what's the lowest threshold? I think Craig used the term, you know, inner infill land. So what is the lowest threshold of change of zoning? So for example, if you have, say, commercial 4 or commercial 3 or whatever, what is the lowest threshold where the WGT can apply? And, you know, I've sort of also make some comment on changes from mixed zoning. What is the lowest threshold where it could come in?
I'm not sure I'll be able to fully answer that because I think it boils down again to the value uplift. So we're going from industrial to residential or something like that. It really, or something else to something else. It's really about the value uplift at the end of the day. I was just wondering, Luana, if you've got sort of any indication of the thresholds just from experience to date, or is it just that relates to value?
Well, I guess the lowest threshold before the windfall gains tax kicks in is the 100,000.
Yeah.
But in terms of establishing what that uplift is between unzoned and rezoned is that $1 million question as to how that's all going to play out. Is that where you were going with that?
The different zones, yeah. So the legislation says you need a change in zone effectively. So it's not very well defined though. And speaking to planning lawyers, I think there is still some uncertainty around what constitutes a change in zone as opposed to a movement within the same zone. So I think if that's where you're going, there is a grey area as to what actually constitutes a rezoning event in that sense at the moment. Yes, Scott, mic coming behind you.
Hi, Scott from Dennis Family as well. Just to maybe expand on that child lot idea, if you're a landowner and you've deferred your payment, so it's been rezoned, but you decide to super lot your property, so your 100 acres, you decide to super lot into 4 25-hectare parcels, what's the liability there? Does the subdivision, the SOC or whatever, does that, or is the liability still deferred?
So have you sold your super lots?
No,
or
no, you've decided to keep ownership of them themselves.
Yeah, so until you get a sale transaction or a change of ownership effectively from a direct land or an indirect entity point of view, you won't crystallise that liability unless the 30 years comes up. So the child lot scenario was more about you're selling the subdivided lots, and the WGT liability becomes progressively payable as each settlement of a subdivided lot occurs. So you don't have to pay 100% of the liability on day one, first settlement. You pay it progressively, and it's based on land area. It just gets progressively paid.
So if you are a landowner, you could, in theory, super lot up your paddock and then sell and then dispose of your lots progressively, and not lose the deferring the
until settlement of gradually of the sales. That's right. Yep.
Yeah. And how does that work with an authority coming in and maybe wanting to buy or transact on your land, like on maybe not a Section 35, but you know, how does the Act or the regulations going to work there?
Yeah, so I think that comes down to what the zoning would be. So whether it's there's a public zone involved there, which would be exempt, excluded zoning, but if it's not, then that acquisition would crystallise the deferred liability.
Okay, and the only other thing I was just going to mention was, how does this all look in terms of kind of long-term lease arrangements? I'm thinking Canberra model or retirement living, where you could have residential units.
Okay, well, it depends whether we're getting into a duty territory, I guess, for long-term leases. And if you've got a dutiable transaction, then you're potentially getting into ceasing the deferral and having to pay the windfall gains tax liability, but it would very much depend on the duty status of those developments.
But there's very little detail about that.
Yeah, it's dutiable transactions, so it just goes straight back into the Duties Act.
Yeah, sorry, I might just add, so that will then become a duty question at the end of the day, even though it relates to WGT in terms of what you're looking to do, whether that constitutes a dutiable transaction. As Craig mentioned earlier, the classic scenarios are like the sale and transfers of land, but the list of dutiable transactions is quite long. It includes a grant of lease for consideration other than rent, and it also includes changes of beneficial ownership. So that's something that we need to look at pretty closely to look at the arrangement that you're doing in relation to the land and whether it constitutes a dutiable transaction under the Duties Act.
Yeah, very important, because we think of duty as in just a standard transfer, but the Duties Act is much broader than that. And if you do have any form of dutiable transaction other than the excluded ones, you are going to crystallise your WGT liability. So you need to be aware of that. Any more questions? No, all done. All right. Thank you very much. I hope that gave you some information to take away. No doubt we would all be happy to take any further questions that you have afterwards. Please get in contact with us. But first of all, please join me in thanking our panel of experts. Thank you for your time. Have a good afternoon. Thank you.